Let's be honest, the world of stock market investing can feel incredibly intimidating. You see the graphs flashing on financial news networks, you hear terms like market capitalization and price-to-earnings ratio, and you think to yourself, that's a club for rich people and finance geeks, not for someone like me. What if I lose all my money? What if I make a stupid mistake? I need thousands of dollars just to start, right? Well, I'm here to tell you that every single one of those fears is completely normal, and more importantly, they're all conquerable. The truth is, starting your investing journey is simpler and more accessible than it's ever been, and you can absolutely start with just the money you have in your pocket right now. This video is your definitive, step-by-step guide to going from a total beginner to someone who confidently owns their first stocks. We're going to skip the confusing jargon and break this down into a simple, actionable plan that anyone can follow. The very first step, and this is where most people get it wrong, has nothing to do with picking a hot stock. It's about getting your mind and your money right. Before you even think about opening a brokerage account, you need to build a solid financial foundation. This means you should have a starter emergency fund in place. Aim for at least $1,000 in a savings account that you do not touch. This is your financial airbag. It ensures that if your car breaks down or you have an unexpected medical bill, you don't have to sell your brand new investments and take a loss. Next, make sure you have a handle on any high-interest debt, like credit card balances. The interest you are paying on that debt is almost always higher than the returns you can expect from the stock market, so paying that down is actually one of the best investments you can make. Once your foundation is secure, it's time to define your why. Why are you investing? Is it for a down payment on a house in 10 years? For retirement in 30 years? Or just to build a general nest egg? Having a clear goal will determine your strategy and, most crucially, your timeline. A long-term goal allows you to take more risk because you have time to recover from the market's inevitable ups and downs. This leads us to the most important concept you will learn today: time in the market beats timing the market. Countless studies have shown that trying to buy at the lowest point and sell at the highest point is a loser's game, even for the professionals. The real secret to building wealth is consistent investing over a long period, allowing the power of compounding to work its magic. Your consistency is infinitely more valuable than your ability to predict the next big thing. Now, let's get to the practical part: choosing your battlefield, which is your online brokerage. For a beginner, you want a platform that is user-friendly, has no account minimums, and offers commission-free trading on stocks and ETFs. Popular options include Fidelity, Charles Schwab, and E-Trade. There are also newer, app-based platforms like Robinhood and Webull that are designed for simplicity. Do a little research, but don't get analysis paralysis. They all serve the same core function for a beginner, which is to be your gateway to the stock market. The key is to pick one and get started. The process of opening an account is very similar to opening a bank account online. You'll provide some personal information, link your bank account for funding, and once it's verified, you're ready to go, with your account funded. You face the big question: what should you actually buy? This is the moment where many beginners panic and either do nothing or make a reckless gamble. Let's simplify this. For the vast majority of beginners, the single best, smartest, and safest way to start is not with individual company stocks, but with ETFs, or exchange-traded funds. Think of an ETF as a pre-made investment basket, instead of buying one single stock, like Apple, and hoping it does well. You can buy a single share of an ETF that itself owns small pieces of hundreds, or even thousands, of different companies. The most famous examples are index funds like the SPY ETF, which tracks the S&P 500, meaning you instantly own a tiny piece of the 500 largest companies in America. This is instant diversification. It dramatically reduces your risk compared to betting everything on one or two companies. It's the ultimate beginner's cheat code. Once you're comfortable with ETFs and have a solid base, you can then consider allocating a small, specific portion of your portfolio to individual stocks. The key here is to invest in what you know and understand. Do you love the products a company makes? Do you believe in its long-term vision? That's a much better starting point than listening to a random tip from a friend. A common beginner mistake is chasing performance, which means buying a stock simply because it has already gone up a lot and you feel like you're missing out. This is a recipe for buying at the peak and watching it fall. Instead, focus on companies with strong fundamentals that you believe will be successful over the next decade, not the next week. And never, ever invest money in a single stock that you cannot afford to lose. Finally, let's talk about the actual process of placing a trade. Inside your brokerage app, you'll search for the ticker symbol of the investment you want, like SPY for the S&P 500 ETF. When you click Buy, you'll be presented with a few options. For a beginner, you will almost always use a market order. This means you are agreeing to buy the share at whatever the current market price is. It's the simplest and fastest way to execute a trade. You'll then type in the number of shares you want, or if you're buying a fractional share, the dollar amount you wish to invest. You review the order, click Submit, and that's it. You are now an investor. The most powerful next step you can take is to set up automatic investments. Schedule your brokerage to pull a fixed amount of money from your bank account every single month to buy more of your chosen ETF. This is called dollar cost averaging, and it automates the habit of investing, removing emotion, and ensuring you're consistently building your portfolio. As we wrap up, remember that investing is a marathon, not a sprint. There will be days when your portfolio value goes down, and that is a normal part of the process. The key is to stick to your plan, keep investing consistently, and ignore the short-term noise. You are building your financial future one share at a time. Before you go, I have to include a crucial disclaimer. I am not a licensed financial advisor. The content in this video is for educational and entertainment purposes only. All investments involve risk, including the possible loss of principal. You should always conduct your own research and consider consulting with a qualified professional before making any investment decisions. Now, your call to action is simple. If you found this guide helpful, hit that like button and subscribe for more plain English financial education. The hardest part is starting. And you've already done that by watching this video. Now, go take that next step.